Hi, my name is Anthony Fulco. This is my Project 2 for Finance 695. This is the Mixed Industry Company Valuation. All right, the purpose of this project is to analyze 18 companies that represent various industries. The industries listed are non-alcoholic beverage, healthcare, heavy equipment, the oil and gas, communications, engineering and construction, and software. All right, the strategy I'm going to use is value investing tendencies to determine the most attractive company. Now, the reason I'm going with value investing tendencies is because that's the investment strategy that I used on my first project, and I really like it a lot. We're going to look at financial measures, management durability, business differentiation, and valuation of the stock and the company. Financial measures. What company consistently performed well? What company avoided excess debt? What company maintained high profit margins? Now, the reason I'm going over financial measures first is because the way I look at it, if you can't give me a return on my investment, if you can't avoid excessive debt, and if you can't generate profits, then there's no reason for me to analyze your company any further. All right, what company consistently performed well? You used ROE. A high ROE is good. ROE is a measure of the rate at which shareholders earn income on their shares. All right, so what I did here is sorted all 18 companies by the ROE, the highest ROE, starting with Monster, Deere, Intuit, Coke, working its way down. And what I did, I basically eliminated any company that didn't generate a positive ROE. So Gentiva, CenturyLink, Tenet Health, and Amedisys I had to eliminate. All right, what company avoided excess debt? I used equity multiplier on this. It measures financial leverage. This is an inverse relationship to ROE. The lower the better. So starting with Monster, Intuit, Jacobs working its way down. You'll see here Deere had a 5.8. Some debt is good, but too much can be a sign of trouble. So I use as a benchmark 4. Any company that had a higher equity multiplier than 4, I eliminated. I understand that Caterpillar and Deere are big equipment construction companies, but even at $5.80 is just too much. It's telling me that for every $5.80 of assets, the company has $4.80 worth of debt. That's just too much. So I eliminated Caterpillar, Community Health, and Deere. All right, what company maintained high profit margins? Profit margins are just measures of operating efficiency. So again, we sorted by the highest. Here, profit margin, you want to look at the highest. So sorting by the highest, we have Intuit, Coca-Cola, Monster, AT&T, Marathon Oil, and Autodesk. I use 10% as my threshold because any company can't generate at least 10% profit margins. It's a company I probably don't want to invest in anyway. So we're eliminating Chicago Bridge, Jacobs, Flora, URS, and Valero. All right, the next tenet we're going to look at is management durability. Value investing, it doesn't only look at financial metrics and stock metrics. It looks at intangibles as well as tangibles. So at this point, we're looking at what company has stood the test of time since the IPO, initial public offering. Want management that can demonstrate an ability to consistently generate profits and survive the highs and the lows of the markets. I'm looking for a company that has been public for more than at least 10 years. All of the remaining companies meet that the 10-year criteria, so all of them are going to stay in, so none of those have been rejected yet. All right, business differentiation. Again, value investing looks at other items besides just the tangibles and intangibles. Value investing basically says we're focusing on buying in a business, not necessarily a stock. So we're going to take a look at what each company that's remaining, what they do. Because I want to eliminate any company that's product as a commodity. So Intuit, develop financial and tax preparation software. Coca-Cola, global leader in the beverage industry. Monster Beverage Corp, lead in market and distributor of energy drinks. Autodesk, world leader in 3D design software. Marathon Oil, oil and natural gas exploration and production company. And AT&T is a multinational telecommunications corporation. Looking for a company that can gain a competitive advantage by offering a product that differentiates itself from companies within the same industry, meaning we don't want a commodity. An example is oil. A barrel of oil is a barrel of oil, regardless of where it came from. Exxon, Valerio, Marathon, doesn't matter. Oil's oil. So based on those criteria, I eliminated Marathon and AT&T because AT&T is the same thing. Whether you're getting a service from Verizon or T-Mobile, AT&T, that product is, in my opinion, is a commodity, so we're eliminating those two. Valuation of a company. Can a company create positive value? All right, we're looking at economic value added here. It's a valuation tool that measures a company's performance by calculating residual wealth in an attempt to capture true economic profit. To calculate EVA, we take our NOPAT, which is our net operating profit after taxes. It's just an adjusted operating profits, less our capital charge. The capital charge is basically a dollar value of what it is costing the firm to finance its capital. And that's how we arrive at EVA. And again, EVA is just how much it is making, how much a company is making above and beyond what it should be making. All right, four that were left. Intuit, Coca-Cola, and Monster all had positive EVAs. Autodesk had a negative EVA. So it's easy to eliminate Autodesk. And again, positive EVA implies that a company is creating returns at a rate above their cost of capital and that a value is made. Negative EVA implies that the cost of capital exceeded business profits, so we had to eliminate Autodesk. All right, so we're down to our top three. I have Coca-Cola, Intuit, and Monster Bev. All right, first we're going to take a look at some financial measures, then we're going to take a look at some management measures, and then finally another valuation tool. So as far as liquidity ratios go, Coke had a current ratio greater than 1, which means it has positive working capital, but just barely. You can see here 117, 105. It's basically, for this is all it's saying, is that $1.17 worth of assets, current assets, over current liabilities. So it's just barely covering current liabilities. Extremely low cash ratios. You can see here 0.61, 0.58. They don't even have enough cash to cover their current liabilities if the obligations were to come due. All right, Intuit had a positive working capital, but not consistent in the quick and cash ratios. They had positive over 1, 2010, 2013, but in 11 and 12, they were under 1, which that's just, you want to have at least over 1 to be able to cover any kind of obligations, current obligations that come due. Monster had positive working capital and the only company with a current ratio that stayed above 2. Now, value investors like current assets to be 2 times the current liability. So you can see here, current ratio 497 across the board, they're greater than 2. Cash ratio, they can easily meet any current obligations if they come due. So on the liquidity ratios, I like Monster. All right, we're going to look at ROE. Now, we know all these companies have a good ROE because they survived the first cut. So what is driving the ROE though? Take a look at Coke. Coke's ROE is driven by high equity multiplier and decreasingly low asset turnover. We see here the asset turnover is just kind of stagnant, it's not really moving and still low. Equity multiplier, this here to me is a sign because this is what's driving up the ROE. It's consistently increasing. Although the profit margin has remained the same for 3 years, the equity multiplier is increasing, driving up an ROE, so it's going to give you, an ROE that it might be high, but not necessarily a good thing high. All right, Intuit's ROE is driven by high profit margins and moderate asset turnover. You'll see here pretty good profit margins for Intuit. That's good. Equity multiplier is still pretty good. It's actually lower than 2, which is always a good sign. And its asset turnover is turning. So I actually like Intuit when it comes to terms of ROE and what the ROE is, what's driving the ROE. Lastly, Monster, their ROE is driven by high asset turnover, high profit margin, followed by low equity multiplier. You can see here Monster consistently every year is turning its inventory over higher and higher. That's a sign of good management and efficient operations. Also, equity multiplier is below low. It's under 2, which value investors don't like too much leverage, so we're looking for equity multipliers at least less than 2, and they fit that mold. All right, market aspects. Top 3 analysis for market aspects. All right, looking at the price for earning ratio, which is basically the share price over earnings per share. This is basically what we think about a company's future relative to its past. Now, generally a high PE implies investors anticipate higher growth in the future. However, a high PE could also indicate a bad previous year. Okay, so we take a look at Monster. All right, you'll see here its PE is increasing almost every single year. So There can be a sign of investor anticipation or investor thinking it's going to grow. And if that's the case, I think it is, and I can tell you why. Because take a look. Got to go back. 1 second. All right, take a look at its earnings per share. Now, again, we just said that the PE ratio, a high PE could be a sign of a bad year, meaning that the denominator has decreased in earnings per share, but we know that's not the case here because Monster's earnings per share, which are the profits allocated to each shareholder, each share of common stock, has steadily increased. So the only thing that can be driving up this PE ratio is the stock price. So we know we got a high denominator. The only thing that can increase the overall number is a high numerator. So to me, that's a good sign. So Monster's share price is driven up by PE, not previous year low earnings. A high profit PE means investors anticipate growth. So again, I like Monster in this category, the continuous growth and highest EPS growth rate. All right, some more market aspects. Again, we're taking a look at stock price year in. This just confirms the previous slides. You'll see here, Monster in 4 years, stock price from 1920 to 52.84, and it's just incredible in a short time. And, you know, and again, even Coke, all of our companies, the last 3 companies' stocks actually did well. Coke went from 28.50 to 36.25. Intuit from 39.75 to 63.92. Stocks all priced to go up, and in this situation, they all seem to be going up as well. But however, I still like Monster most because of the growth rate, the stock growth rate. Next, we take a look at beta. Beta measures a stock's volatility compared to the market. A beta greater than 1 means the stock is more volatile than the market, and a beta less than 1 means the stock is less volatile than the market. All of them have pretty good betas. Coke at 0.41, Intuit 0.71, but look at Monster. If greater than 1 is considered volatile, then they're at negative 0.05. So there's just really no risk at all associated with this stock. All right, and this here is interesting, dividends. Take a look at the dividends. Now, Coke from 2010 to 12, they did slowly increase at a small percentage. That's kind of what we call a sticky dividend there. Now, this is interesting. Intuit offered stocks in 2010, no dividends in 2010, no dividends in 2011, but then they started paying dividends in 2012 and 2013, while Monster still offers no dividends. So what does this tell us? First of all, it tells us that Intuit no longer has any positive net present value projects on hand, so they're taking their earnings and they're giving them back to the shareholders in the form of dividends. Whereas Monster pays no dividends, stock prices are still climbing. That tells us that Monster still has positive net present value projects, and that it can do better with our money than we can. So I like that. All right, top 3 stock valuation. What is the intrinsic value of the stock, and is the stock overvalued or undervalued? We've got down to 3 companies. I'm basically going to use this valuation method to determine of the last 3 which one I like the best. I like Monster on a lot of the financial measures we just looked at, but still I'm going to use this tool to determine which one of the last 3 is going to be the better company. All right, first of all, to get the intrinsic value, we need to determine the total future cash flows of the dividend and stock. For the dividend growth, I just used a change in the quarterly payout. For the stock growth, I use an average annual return rate of 3 years because I only plan on keeping the stock for 3 years. So if I was going to keep it for more than 3 years, 5 years, I would have used the growth model. But since I'm only keeping it for 3, we're going to use a discounted cash flow model. All right, so we're going to find the present value by discounting future cash flows. Here's the formula right here. I'm sure we've all seen this before. CFN is cash flows in period in. D is a discount rate and the weighted average cost of capital. Now, for my discount rate, I like that weighted average cost of capital because basically that is the return rate that the market says it wants for its total capital investments. All right, so to find the intrinsic value and determine if the stock price is undervalued at least 25% of its intrinsic value, we got to take, let's see, Fulco, total future cash flows for 3 years was $49.62. The discounted rate was applied. Once you apply the discounted rate, which is the weighted average cost of capital, came to 40.77. That became our intrinsic value. That's the intrinsic value of the stock. Now, I like to have a margin of safety because stock valuation, especially intrinsic valuation, is not a science. A lot of it is guessing. You guess on your growth rates, on discount rates. So by using a 25% margin of safety, you have a little bit of room of error when you're calculating the intrinsic value. So I'll apply a 25% discount intrinsic value. The current stock price, $41.65. Is the stock price less than discounted intrinsic value? No. All right, next take a look into it. Future cash flows of $117.60. Discounted at the weighted average cost of capital, which is our intrinsic value, is $90.26. The intrinsic value discounted at 25% is $67.70. Current stock price is $84.02. So the current stock price is not less than the discounted intrinsic value, so that stock is overvalued. Next, Monster. We have a 3-year future cash flow of $155, discounted at the weighted average cost of capital. We have an intrinsic value of $121. The intrinsic value discounted at 25% is $91.26. Current stock price $89.76. Is the stock price less than the discounted intrinsic value? Yes, it is. This is an undervalued stock. So, in conclusion, we're going with Monster. As far as a recap, financial measures. ROE, 41.38%, of the highest of all companies. Equity multiplier, 1.43, the lowest of all the companies in the sample. Profit margins of 15.08%, third highest behind Coke and Intuit, which were in our top 3. Management durability, public company since 1995. Business differentiation, offers niche products in the non-alcoholic beverage industry for almost 20 years. And then I like its intrinsic value. It's a positive EVA, and the stock price was less than the intrinsic value of the stock discounted at 25%. So that's the end of the presentation. We're going with Monster. Thank you.